Hi everyone, welcome to today's video. So you might have seen in the stock markets right now that some days the markets are going up, you feel very happy. Some days the markets are going down, you feel really depressed. And this is a highly volatile situation. If you are a new investor, this can really churn your stomach. You will not feel easy investing in this type of stock market, and even good investors panic under such situations. Now, the worrying part is that going forward, my assessment is that the markets are going to become even more volatile, at least in the short term to mid term. And I will break down that argument why that will happen. So, the objective of this video is very simple. I will help you break down macroeconomic arguments in very easy to understand language so that you don't panic if you are an investor in the stock markets right now. B, in case you feel that you can't handle this volatility, your option 2 is to go to the bond market and start taking some positions. Which brings us to the sponsors of this video, which is Wint Wealth. In the interest of full disclosure, I am an investor in this company. It's an excellent company through which you can start taking some positions in the bond market. That's an option for you. You can go check it out. It's a wonderful company. And in case stock market volatility is something that you're not happy handling, bond investing is something that might make a lot of sense for you. So let me help you understand three very important things right now that will give you a lot of confidence in the stock market. One, the overall pulse of the market and what actions the Fed, the US government, is taking, because that will impact India also a lot, absolutely a lot. So please listen to that part. Second key part is that I will help you understand what impact the Fed actions, especially around quantitative tightening, will result in the Indian market and the US market. Third, will the stock market crash and what actions you should be taking as an investor? So first and foremost, I would want you to take a look at this chart. This shows quantitative easing. Now, quantitative easing in simple word means that the government, US government, Indian government, bunch of other different governments, they are printing money and flushing it down the economy. So there is a lot more money available in different economies. So if you take a look at this chart, you will see that quantitative easing started quite aggressively post 2008. So this is the first leg which happened of quantitative easing, and there was a lot more money available post 2008 due to quantitative easing in economies. Now this excess liquidity was not withdrawn from the market. Then again 2020 hit and there was another massive round of quantitative easing that took place. So as a result, even today, there is a lot of excess liquidity that is available in the market. Now you'd say that, okay, Akshat, if the government has printed money, how does that impact the stock market? Actually, that is one of the foremost things that impacts the stock market, because if there is just a lot more money available with everyone starts investing in different companies across different assets. So it leads to asset price inflation. And that is one of the primary reasons that anyone who invested in the stock market in 2020 literally ended up making 50-60% return very easily. This was simply because of excess liquidity being available in the market. So just to help you understand this entire flow in very easy to understand language, so there was excess liquidity since 2008 and this has continued even till date since 2020 onwards. So because of this excess liquidity, the stock markets have gone up. And right now in 2022, the economy is exhibiting mixed signals. So what do I mean by mixed signals? So number one, if you check the unemployment data in the US, the unemployment rate is very low in the US. So that means that people are employed, they are finding employment, good things are happening in the economy. So this is a positive sign for the economy. On the flip side, if you check the inflation data, the inflation roughly is 40-45 year high and it is close to 7.5% monthly inflation, which is very high for a developed economy like the US. I'll say, Akshat, what happens with inflation? What is inflation? So inflation in general terms, प्याज टमाटर के रेट बढ़ जाना, right? So that is what inflation is, that it's a general increase in price rise, and every basic item that you use, if the prices of those items become very expensive, then it becomes what? Then it becomes a political problem. And that is precisely what is happening in the economy right now, that because the inflation is very high, it has become a political problem, and governments all across the world are firefighting with inflation. Because think about it this way, that if the pyaz tomato rates have gone up and if everything is costing a lot in the economy, then you will be at the head of politicians demanding answers that, why has everything become so expensive? So politicians have a lot of incentive to firefight inflation, and that is precisely what they are doing. Now, how are they doing it? So let me take you to Mr. Mohamed Erian's commentary on this topic. Mr. Mohamed Erian is one of the biggest asset fund manager, and he manages an asset fund called as PIMCO. So he's a very good macro investor, but he's a debt investor. So he invests in bonds mostly. So listen to his commentary and then I will give you my view on this.
Yeah, 7 rate hikes from Bank of America. The center of gravity is between 5 and 6. 40% chance now, according to the market indicators, of a 50 basis points hike in March. We've seen this massive realignment of expectations. I think they're excessive, not because the Fed is not behind, it is way behind. And because it is way behind, it has lost control of both the inflation narrative and the rates narrative. But I question as to whether the economy can take 7 rate hikes with quantitative tightening on top of that. So this is going to be quite an interesting time. The good news, Becky, we must not forget that, is as you heard from Mike, stock markets have been incredibly resilient to what's been happening in fixed income.
So one of the key points that he mentioned was that the Feds or the government, because government control Feds or the central banks, so the government has been way behind with this inflation narrative. Now this is a very, very important concept for us to understand, because if the inflation is just literally going out of hand and the government is not able to balance this situation, it becomes a hugely political issue and the government will have to take really fast actions here. And that is what government has started to do. So back to Mr. Mohamed Erian, and there is a question that has been asked to him that, hey, this year it has been stated that Feds are going to increase the interest rate 7 times. 7 times, that's very, very high. Plus, they are going to do something called as quantitative tightening. So listen to this commentary, then I will give you my viewpoint.
What would the market's reaction be if we actually saw 5, 6, 7 rate hikes? Would they cheer it because it would be something being done to slow inflation, or would they be very concerned about that? And same thing if they don't. If they only do 2 or 3 rate hikes, what's the market's reaction if inflation continues to climb?
So because the Fed is so slow and behind, there is no first best. You have to. So the question you ask is really important, but it's hard to answer. My own gut feeling is there's 2 things that have kept stocks relatively resilient. One is corporate earnings, and 2 is behavioral conditioning. And that both of these things have come in. And we've seen when there's a surprise on corporate earnings, whether it's on the way down, Facebook, or up, Amazon, you get outsized moves because liquidity isn't there. Put that into context, a lot will depend on whether the economy can absorb 7 hikes and QT. I'm worried, to tell you the truth, as to whether it's going to absorb it. I didn't want to be here in terms of having to go do so much because the Fed is so late. But unfortunately, this is where we are.
So if they do rate hikes and quantitative tightening, maybe that gets them to the point where they feel like they're getting control of the inflation picture. But you've got $19 trillion that individuals and companies now have in terms of what they can spend. That is a lot of money out there floating around. Even if the Fed does start acting pretty quickly, how long do you think the inflation picture can continue, can keep pushing higher?
Yeah, and remember, the Fed is still injecting liquidity into the system.
Right.
The ECB is still injecting liquidity into the system. I mean, who would have imagined we would have a 7.1% inflation reading? People think consensus is that Thursday's number will be 7.3%, with core going up to 5.9, and yet we are still injecting liquidity into this economy. This is how out of date and behind Fed policy is. So hopefully they can regain control of the inflation narrative. Hopefully they can regain control of the rates narrative. My concern is that the market is running away with rate hikes that are in excess of what I think this economy can absorb.
So let me very quickly help you understand first and foremost the difference between quantitative tightening and rate hike. So rate hike simply means that the RBI or the central bank, in the US's case it is Fed, they come out and they say that, you know what, banks, Bank of America, Goldman Sachs, you go and start paying more money on fixed deposit. So they have raised the interest rate. So this rate hike has been instituted by the central bank. So as a result, what will happen is that a lot of money will shift from stock market to fixed deposit or bond market. So it is estimated that Feds are going to increase this rate 7 times this year. Now this is very, very big deal. That's point 1. Point 2 is what is quantitative tightening? So quantitative tightening is the opposite of quantitative easing. In quantitative easing, roughly speaking, government is just printing money and throwing in the economy. In quantitative tightening, the government stops printing money and through bond action, they withdraw money from the market. You don't need to get into the economics of it. The simple argument is that what these two actions lead to is that it leads to extraction or decrease of money from the economy. So that is the simple thing that is happening in the economy right now. Now, why is this thing such a worrying sign for the stock market? And why is it that several commentators like Mr. Mohamed Erian are not feeling very enthusiastic about the stock market? Because they say that, you know what, the Feds have already fallen behind in this inflation game, and going forward, they just have to speed up this entire process of withdrawing liquidity from the markets, and as a result, there is a chance that the stock market will fall. So now this brings us to the final section of the video, that will the stock markets fall? Everyone is giving their own commentary. Now, of course, I am entitled to my viewpoints also, and every investor is entitled to their own viewpoint. Now, according to Mr. Mohamed Erian, the situation looks panicky, no doubt about that. There are a lot of people who will be on the spectrum and they will say that, you know what, stock markets are definitely going to fall. My viewpoint is this, and I can be wrong, no doubt about that, but this is what I think. That first and foremost, as Mr. Mohamed Erian himself says, that the corporate earnings of different companies are up even in this environment when the Feds have announced liquidity withdrawal from the market. For example, a lot of companies have made announcements about their results. Yes, the stock prices have come down, but the results of the company is not bad. So fundamentally, the companies are still holding and maintaining their positions. Their revenues are growing, profits are growing, and good things are happening from a corporate earning perspective. This is point one. Point two, if we reach a situation where the growth shrinks or if the stock markets correct significantly, then what it would lead to is that it would lead to a lot of panic. Why? Because there is a lot of debt still right now on the world. And the only way to service the debt is very simple, that the companies need to keep on operating at a brisk pace. The economy needs to run at full steam for the simple fact that that is the only way to bring debt down. Imagine a situation that if right now there is a recession or a depression in the market, what will happen? Companies will shut down. The jobs will go away, all bad things will happen, and the debt still remains high. And government will again institute something called as quantitative easing in case they feel that the growth has slowed down quite a lot. So therefore, they can't push stock market investors in a situation where the stocks have corrected by a lot and there is general panic in the market. So that panic situation will not happen. Now, third and final point is that the only way to manage this high debt, high inflation type of an environment is the productivity increase needs to eat into inflation. So my argument from a macro point of view would be that we have reached a situation, or the world has reached a situation, where the only way to navigate this situation successfully now is that we can bring down debt by increasing the productivity of the companies, for which the governments across the world will have to, from time to time, keep on doing that quantitative easing game. So in summary, this is what is going to happen in the market according to me, that in good periods, like where we are existing today, that corporate earnings have been high, people are employed, unemployment rate is low, mostly good things are happening in the economy. During such times, the government is going to step in and will try to control inflation. As they control the inflation, the stock prices are going to go down. But government will again step in and try to prevent any massive correction that might happen in the stock market. So therefore, this volatility during this entire game is going to stay very high. You can continue to monitor MACD, RSI, this, that, technicals, nothing will help. It is pure macroeconomic play that is being exhibited in the economy right now. And this situation is at least going to continue for the next few months. So in case you are an investor who can't stomach this volatility, who can't see the stock prices drop, etc., please take some positions in the bond market. So there is nothing off in the bond market per se. And you could also consider checking Wint Wealth from that perspective. On the flip side, if you're very confident and you're okay with seeing your portfolio in red from time to time, that is fine, because you are going to see a lot of red, green happening, and that switching happening in your portfolio every now and then, because the volatility is generally going to be high. So I hope you enjoyed the video. Please give it a thumbs up and I will see you tomorrow.